In this lesson, we'll explore the crucial role of banking and reserves in our financial system. As we've learned, the US dollar currently serves as the world's primary reserve currency. A reserve currency is a foreign currency held in significant quantities by governments and institutions as part of their foreign exchange reserves. It's used in international transactions, investments, and all aspects of the global economy. Having a reserve currency facilitates global trade by reducing exchange rate risk and transaction costs. The US dollar has held this status since the Bretton Woods Agreement in 1944. Countries issuing a reserve currency can borrow at lower costs and have more flexibility in monetary policy. The status of a reserve currency impacts international economic stability, trade dynamics, and geopolitical power balances. When we need cash, such as US dollars, we go to our local bank. These banks are part of a larger banking system. The banking system is a network of institutions that provide financial services like accepting deposits, providing loans, and offering investment products. It plays a vital role in the economy by facilitating transactions, allocating capital, and managing risk. Let's explore the different types of banks and the critical roles they play in the economy. There are several types of banks, each serving a distinct purpose. Central banks regulate the money supply, oversee monetary policy, and act as a lender of last resort to ensure financial stability. Commercial banks cater to individuals and businesses by offering deposit accounts, loans, and a variety of other financial services. Investment banks specialize in large-scale financial transactions, such as mergers, acquisitions, and underwriting securities. Together, these banks form the backbone of the banking system, which performs key functions essential to the economy, including intermediation. Banks connect savers and borrowers, channeling funds from those with surplus capital to those who need it. Payment systems. They enable seamless transactions through tools like checks, electronic transfers, and payment cards, making commerce efficient and reliable. The banking system is more than just a network of institutions. It's a vital mechanism that powers the flow of money and supports economic growth. The banking system is heavily regulated to ensure stability, protect consumers, and maintain confidence in the financial system. However, the 2008 financial crisis exposed significant shortcomings in these regulations, demonstrating that they were not always sufficient to prevent systemic risks and financial collapse. Let's take a closer look at central banks, focusing on two of the most influential ones: the Federal Reserve in the United States and the European Central Bank in the Eurozone. The Federal Reserve, or Fed, serves as the central bank of the United States. It's tasked with implementing monetary policy, regulating banks, maintaining financial stability, and providing financial services to the government and the public. The European Central Bank, or ECB, is the central bank for the Eurozone. It manages the euro currency and sets monetary policy for its member countries. Both of these central banks play a pivotal role in the economy by performing key functions: open market operations where they buy and sell government securities to regulate the money supply, setting interest rates which determine the cost of short-term loans for commercial banks, and imposing reserve requirements which mandate the minimum amount of funds banks must hold in reserve. Their primary objectives align to promote maximum employment, stabilize prices, and ensure moderate long-term interest rates. Together, they shape monetary policy and influence the global economy. As mentioned, central banks mandate the amount of funds that commercial banks must hold in reserve. This brings us to the concept of fractional reserve banking. In this system, banks keep only a fraction of customer deposits in reserve and lend out the remainder, effectively creating new money through lending. By lending out deposits, banks increase the money supply through the money multiplier effect. However, if too many depositors withdraw funds simultaneously, a situation known as a bank run, a bank may become insolvent because it doesn't have enough reserves to cover all withdrawals. This system means that the money in our bank accounts functions as an IOU, where the physical cash doesn't fully back all deposits. If everyone wanted to withdraw their funds at once, the banks wouldn't be able to fulfill all requests. Central banks play a crucial role in managing the economy through monetary policy, often described as money printing, especially during times of crisis. Money printing is a term used to describe how central banks increase the money supply, and this can be achieved through various mechanisms, including quantitative easing, where central banks purchase government securities or other financial assets to inject liquidity into the economy. Lowering interest rates, which reduces the cost of borrowing, encouraging both spending and investment. These actions have profound effects on the economy, such as stimulating growth by boosting economic activity during downturns, raising concerns about inflation if too much money floods the economy, driving prices higher, and potentially devaluing the currency as increased money supply can weaken its value. Through these tools, central banks aim to stabilize the economy, but their actions come with both benefits and risks that must be carefully managed. Let's dive into an example of monetary policy in action: stimulus checks. Stimulus checks are direct payments from the government to individuals, designed to ignite economic activity by encouraging consumer spending. These payments play a crucial role in times of economic uncertainty. They act as an economic stimulus, injecting money into the economy during recessions or crises, like during the COVID-19 pandemic. They support households by offering financial relief to individuals who are struggling with unemployment or reduced income. And they provide a short-term boost, leading to immediate increases in consumption. But of course, there are trade-offs. They can lead to budget deficits, increasing government spending, and potentially widening fiscal imbalances. And there's always the concern of inflation. Adding more money into circulation can drive prices higher. This brings us to an important consequence of increased government spending: national debt. National debt is the total amount of money a government owes to its creditors, both domestically and internationally. Understanding these dynamics helps us see how monetary policies shape our economy and why finding the right balance is always a challenge. Let's take a moment to explore the implications of high national debt. When a country carries significant debt, it can have far-reaching consequences. High debt levels can restrict future government spending and limit investment in areas like infrastructure, education, or healthcare. Rising interest rates. Large debts often lead to higher interest rates, as investors seek greater returns to offset the increased risk. And finally, future generations may be left with the responsibility of repaying today's debt, raising questions about fairness and sustainability. High national debt is more than just numbers on a balance sheet. It's a challenge that shapes the economic landscape for years to come. Let's talk about interest rates, an essential factor in the economy that represents the cost of borrowing money or the return for lending it. Interest rates play a pivotal role in shaping economic activity by influencing consumer behavior, business investment, and inflation. Lower interest rates make loans cheaper, encouraging borrowing and spending, which can stimulate economic growth. On the other hand, higher interest rates reward saving, motivating people to save rather than spend. These fluctuations in interest rates have a direct impact on what's known as the M2 money supply, a key measure of the money circulating in the economy. The M2 money supply includes M1 money supply, which covers the most liquid forms of money, such as cash, checking deposits, and traveler's checks. Savings accounts and time deposits, which are slightly less liquid but still accessible forms of money. And money market mutual funds, which offer higher interest rates compared to traditional savings accounts but may not be as readily accessible. Understanding how interest rates influence borrowing, saving, and the money supply provides valuable insight into how the economy functions and adapts over time. Changes in the M2 money supply reflect the level of liquidity available in the economy and are influenced by central bank actions. For example, during quantitative easing, the M2 supply can grow rapidly as banks have more reserves, encouraging lending and investment. However, excessive increases in M2 can lead to inflationary pressures, particularly if the growth outpaces economic production. Understanding banking and reserves is essential for grasping how our modern financial system operates. From the role of reserve currencies and central banks to the mechanisms of monetary policy and its impact on the economy, these components are integral to global finance. As we navigate economic challenges and changes, knowledge of these concepts empowers us to make informed decisions and better understand the forces that shape our financial world.